The Case for Gold. I'm Jack Otter, editor of BARRON'S.com. I'm here with Fred Hickey, who is editor of the High-Tech Strategist newsletter, a longtime member of the Barron's Roundtable. And even though your expertise, your focus is on high-tech, of course you also look at the big picture economy, and right now that's leading you to gold. Can you explain?
I think it's important that everyone consider the big picture, because if they didn't consider the big picture, they would have been destroyed in 2000, and they would have been destroyed in 2007.
And we should point out that in 2000 you were warning of a bubble in tech.
Both times. I was shorting even, and then I bought after the declines. Similar kind of situation here, where we see extreme enthusiasm in the market, record bearishness, well, 26-year level of bearishness in investors' intelligence. We see record margin debt, and valuations are extreme. I'd consider buying Amazon if it wasn't 543 times earnings. The NASDAQ went up 38% last year on top of 4 years of gains. People should be worried. That's keeping me out of tech. I'm likely going to short when I see the market roll over at some point this year, and I think that will happen.
But right now you think it's dangerous to short because of macro policy?
Well, it's going to be dangerous for a whole year, so I'm not going to recommend a long-term short. It will be very short-term, just waiting for the dislocation that I think will come, and it likely will come when the Fed tapers. Well, they're starting to taper now, but one of the tapers that occurs this year will be the straw that breaks the camel's back. We saw in 2010, when QE1 ended, the stock market fell 14%. When QE2 ended in 2011, the stock market fell 17.5%. And now we're going to cut the amount of printing month by month until supposedly at the end of the year we'll be down to zero. That's going to lead to a problem, I think, with these very unstable prices that we have.
Because you've made the case that all this money printing that's going on in the U.S. and abroad has been blowing up this big bubble.
It's blowing up a big bubble everywhere. We've had $9 trillion printed worldwide here by the major central banks. So yes, it's very dangerous. There's likely to be some kind of dislocation. There'll be volatility this year, and I hope to be able to take advantage of it. But I won't short for the whole year. I'm only going to short very briefly. And then I could buy, because I expect QE5 to come and even more printing, and the stock market could end up on the year. So I really don't want to be short. I'll only be short for a short period of time.
Okay, but within this context, there is one long that you have, because it's not in high tech. It's a protection really against these bubbles.
It is, and also it's one area that has been destroyed. So we had a 12-year bull market in gold. It topped in September 2011, 1900. Gold itself fell only 1 year, last year, by 28%, but gold stocks have fallen for 3 consecutive years. They fell 16% in 2011, they fell 10% in 2012, and they fell 55% last year. And the junior miners fell even more, for a total decline of 2/3, 66% decline in gold miners, and an 80% decline or more in the juniors. I'm as excited as people were, as greedy as they were in 1999 for tech stocks, they're as panicked today on the opposite end in gold stocks. So I recommended them last year. It didn't work out very well, but I'm staying with them because one, they're grossly undervalued, and two, gold will protect you in a money printing environment.
So why is it that gold miners have been hit so much harder than the metal itself?
That's typically what happens. So you know, they'll decline a lot, but then they'll also rally a lot. So we had a very similar decline in the middle of the 1970s bull market, for secular bull market for gold. We saw a 66% decline in the price of gold miners, less so in the price of gold. Coming out of that, though, the top miners in the world went up by a factor of 10 times on average. Gold stocks don't always go down as people think these days. They also go up, and when they go up spectacularly. When we hit a bottom in gold in the 20-year bear market in 1999-2000, the Huey gold index went up by 15 times over the next 8 years, 2008. When we came out of the 2008 decline, gold stocks went up four times over the next 3 years, and 90% in 1 month. So there's extreme opportunity here in a market that's overbought, and where there's very little to buy from.
Can you give us an example of a miner you like?
Well, I like to buy ones that have very good balance sheets, and because it's difficult to get funding right now, and they have low costs. So one of them is Agnico-Eagle Mines. It has 7 mines. They're in the best locations in the world: Canada, Finland, and they have a couple in Mexico. So those considered to be very safe locations. In addition, they have enough cash that they don't have to go to Wall Street or get cash at all. In fact, they told Wall Street, Goldman Sachs conference just a month ago or so, they don't need any cash, sorry to the bankers. And they have enough funding that they're actually taking advantage of the distress of many of the junior miners and making investments in all of them. They made one in December. So this is a company that is taking advantage of the situation because of their strength and their low costs. They've been dropping their cost to produce. They're not threatened by this $1,200, $1,250 gold price. They won't go out of business. They'll be there because their cash costs are so low. So that's one of them.
Thanks very much, Fred.
You're welcome.